It's September 3rd, 1929. The Dow Jones Industrial Average has just hit its all-time high 38117. This is a 500% increase from just 8 years earlier. Everyone believes they are a financial genius. Why? Because they are buying stocks on margin. They only have to put down 10% of the money. The bank or their broker loans them the other 90%. Total margin debt has exploded to over $85 billion. That is more than the entire U.S. federal budget at the time. The economy looks unstoppable. The roaring 20s are a permanent new era of prosperity, but it's an illusion. It's a skyscraper of wealth built on a foundation of dynamite. To understand the cracks forming in our economy today, we have to go back to the day that dynamite was lit. The fuse was lit on October 24th, 1929. Black Thursday. The market suddenly dropped 11% at the opening bell. Panic selling began. A group of top bankers, including Thomas Lamont from Morgan Bank, pooled their money. They spent $250 million buying major stocks to show confidence. It was a PR stunt. It worked for about 48 hours. The real collapse came on Tuesday, October 29th. Black Tuesday. The ticker tapes couldn't keep up. They ran 2.5 hours behind the actual trades. People had no idea what their stocks were worth. They just screamed. Sell 164 million shares were traded. It was a record that stood for 40 years. By 3:00 p.m., $14 billion in wealth had vanished. By mid-November, the market had lost 50% of its value. $30 billion was gone. That's $480 billion in 2025 money. This wasn't a correction. It was an annihilation. But here's where it gets interesting. Why did this happen? It wasn't just margin debt, it was a bubble of belief. In the 1920s, the hot stocks were companies like RCA, the Radio Corporation of America. It was a new revolutionary technology just like AI is today. Investors piled into radio stocks, pushing their value to 100 times their earnings. They weren't buying a company, they were buying a story. Does that sound familiar? Today we don't have just radio stocks. We have tech stocks with 400x PE ratios. We have cryptocurrencies based on dog cartoons worth $50 billion. We have meme stocks for video game retailers with $0 in profit. In 2021, a single app, Robinhood, added 10 million new users. The tools have changed. The speed has increased. The human psychology is identical. The 1929 stock crash wasn't the Great Depression, it was just the trigger. The real pain came after, when the financial collapse hit the real world. President Herbert Hoover famously said, "The fundamental business of the country is on a sound and prosperous basis." He was wrong. The crash exposed two deep underlying weaknesses. First, the banking system was a house of cards. Second, the farm economy was already dead. During the 1920s, 6,000 banks had already failed. They were small rural banks with no insurance. When the crash hit, people ran to get their savings. This is a bank run. In 1930, 1350 banks collapsed. In 1931, another 2294 collapsed. By 1933, over 9,000 of the nation's 25,000 banks were gone. $7 billion in deposits, wiped out. Which brings us to today. You might think that can't happen now. We have the FDIC, we have deposit insurance, we have stress tests for the big banks, but our system is just as fragile, only in a different way. Look at 2008. The system wasn't built on margin loans. It was built on mortgage-backed securities and credit default swaps. When those failed trillion-dollar firms like Lehman Brothers vanished in a weekend, the government had to bail out the entire system. And in 2023, we saw Silicon Valley Bank. It was the 16th largest bank in the U.S. It failed in 48 hours. It wasn't a bank run of people in cloth caps lining up on the street. It was a digital bank run. $42 billion was pulled out in 10 hours. Via smartphone app. The speed of collapse is now faster than the speed of regulation. The risk is still there. It's just hiding. So what did the government do back then? The Federal Reserve, the lender of last resort, made the single worst decision possible. It tightened the money supply. It raised interest rates in 1931. It was like trying to cure a heart attack with a punch to the chest. Then Congress decided to help. In June 1930, they passed the Smoot-Hawley Tariff Act. It raised tariffs on over 2,000 imported goods to protect American jobs. It was a disaster. Other countries immediately retaliated. They raised their own tariffs on American goods. Global trade seized U.S. exports to Europe dropped from $23 billion in 1929 to just $784 million in 1932. That's a 67% collapse. The tariff didn't just deepen the recession, it exported it to the entire world, creating a global depression, and then everything changed. After the 2008 crash, our Federal Reserve did the exact opposite of the 1930s Fed. They didn't tighten, they printed. They dropped interest rates to 0% and held them there for a decade. They started quantitative easing, or QE. It's a polite term for creating trillions of dollars out of thin air. The Fed's balance sheet went from $900 billion in 2008 to $9 trillion by 2022. A 1,000% increase. All this new money had to go somewhere. It went into stocks, it went into real estate, it went into crypto. It created the everything bubble. And just like in 1930, we started new trade wars, tariffs on steel, tariffs on solar panels, tariffs on microchips, global supply chains which we thought were invincible, shattered. The 1929 model was a private debt bubble plus protectionism. Our model is a government debt bubble plus protectionism. It's the same song, just in a different key, but the most haunting echo, the real ghost, isn't the stocks or the tariffs, it's this. In 1928, the top 1% of Americans earned 239% of all income. The wealthiest, 1%, just 2,000 people held 25% of the nation's wealth. The gap between the rich and the poor was a canyon. This meant the entire U.S. economy was balanced on the spending habits of a tiny few. The 99% didn't have savings. They were living paycheck to paycheck in 1929. When the 1% stopped spending, the whole system fell over. The 99% couldn't buy the products their own factories were making. This was the core sickness. The crash was just the symptom, which brings us back to now. Fast forward to today. The top 1% of Americans now hold 31% of the nation's wealth. The top 1% hold nearly 20%. We are at or have surpassed the 1929 levels of wealth concentration. We don't call it paycheck to paycheck anymore. We call it the gig economy. We call it two-income households that still can't afford a home. In the 1930s, the unemployment rate hit a catastrophic 2.49%. Today, politicians tell us unemployment is at a 50-year low around 4%, but that number is an illusion. It doesn't count the 100 million Americans not in the labor force. It doesn't count the person with 3 part-time jobs and no benefits. We've just gotten better at hiding the poverty inside spreadsheets. We call it a K-shaped recovery, which is just a polite way of saying the rich got richer and everyone else got left behind. This isn't just data. In the 1930s, this was human desperation. It was the Dust Bowl, a man-made environmental catastrophe. Farm foreclosures forced 25 million people to migrate from their homes. They were called Okies. They were Americans treated as invaders in their own country. Soup kitchens in New York City served 85,000 meals a day. Today, the desperation looks different. It's not a soup line, it's a food bank line that wraps around a stadium. Over 53 million Americans turned to food banks last year. It's not the Dust Bowl, it's the housing crisis. The median U.S. home price has jumped from $32,000 to $43,000 in just 4 years. A 30-year mortgage rate went from 29% to 72%. A new mortgage payment on a median home is 80% higher than it was in 2020. The American dream of owning a home is now a mathematical impossibility for 60% of the population. So here is the ghost of 1929. It's not a single event. It's a pattern. It's a speculative bubble fueled by 15 years of 0% interest rates. Check. It's dangerously high levels of government, corporate, and private debt. The U.S. national debt just crossed $34 trillion. Check. It's extreme wealth inequality matching the 1920s. Check. It's a breakdown in global trade and the rise of protectionism. Check. In 1929, the bubble popped and the Depression followed. In our time, the Depression might be happening slowly all at once. It's a silent crash. A crash in your purchasing power. A crash in your standard of living. The S&P 500 might be near its all-time high. But if a gallon of milk is $5 and a new car is $5,000, are you really getting richer? The system is flashing the same red lights it did 96 years ago. The question is no longer if the bubble will pop. The question is what pops this time. The 1929 playbook shows us two possible endings: a sudden violent crash like Black Tuesday that wipes out the system overnight, or a long grinding decade of pain like the 1930s where everything slowly gets worse. So which one do you think we are facing? Is it a 1929-style great crash? Or is it a 1970s-style lost decade of inflation and stagnation? Drop your prediction in the comments below and subscribe, because we're going to be tracking the data to see if you're right.